this video, we'll be introducing you to the basics of technical analysis, often called charting. As an investor, you probably already read the Financial Times, the weekend supplements, and possibly the Investor's Chronicle as well. But do you ever get the feeling, reading all the comments from the city analysts, that you may have already missed the boat? A share's price at any given time reflects all the known facts about it. But do you sometimes get the feeling that those facts are only known to a few people? Well, charting is all about improving the timing of your investment decisions by predicting the movements of a company's shares. Quite simply, charts show whether buyers or sellers are getting the upper hand. And from that, the chartist predicts what a share's future performance will be. Now, the word prediction conjures up the idea of soothsayers and crystal balls, doesn't it? And some view charting as nothing short of witchcraft.
Many people think it's all mumbo-jumbo.
Those who forecast exchange rates by watching wiggly lines on charts.
What's more shocking is that there's even a so-called profession which believes prices move in trends.
The men who read the entrails of past share prices to predict the future.
Neville Wood is a market maker with city brokers Shearson Lehman. Neville, I know that initially you were sceptical about technical analysis. What made you change your mind?
5 years ago, I went to Chicago, really sent by the firm to see the viability of the futures market. And during one of the lectures there, a guy stood up and lectured for an hour on technical analysis. And I think it was just the sheer enthusiasm of the speaker and the audience. I mean, he was using words I didn't really know about at the time: head and shoulders, necklines, breakouts, and key reversals.
How can charting be useful to the private investor?
Especially since Big Bang, the private investor is really on a much better footing. And technical analysis, one thing it does do for him, it gives him more discipline, i.e. he knows when he's right or when he's wrong. It gives him an insight as to whether the market is overbought or oversold. And really it puts him on a much the same footing really as a market maker.
Thank you. Well, like me, you might have been a bit baffled by the use of apparently mysterious phrases like head and shoulders and necklines, but I'm relieved to say we'll learn what they mean in a few moments. Now, Neville is only one of hundreds of institutional clients to whom investment research sends its regular charts and publications. If he didn't believe that technical analysis helps him make money, he obviously wouldn't buy it. However, if you still need persuading that past performance of shares can teach us something about the future, look at this. Early this century, the Dow Jones performed like this, approaching the great crash of 1929. Now, would you believe, this is what happened to the Dow Jones in the years up to the great crash of 1987. So history can repeat itself when it's a question of human behavior. The fact is, most of us do react to certain situations in similar ways. Greed can drive us on in bull markets, and fear persuade us to sell in bear markets. If you like, it's the herd instinct. By the end of this video, you'll have learned to recognize some of these patterns of behavior, and by that time, you'll be well on the way to using these charts to improve your investment performance. To that end, a word or two about how to use this video. Before each graphic, you'll see a caption like this. It's there to give you an easy reference point so you can fast wind through the tape when you want to check something. So if you don't understand a particular point, stop the tape and wind back. I won't mind a bit. Besides, there's no need to try to take all the information in at one viewing. And at the end, we've designed a video game for you to test your charting skills. The first thing a chartist wants to do is establish whether there's a definite trend up or down, whether there's investor confidence or a lack of it. Take this share, for instance. It's having its ups and downs, but the general trend seems to be upwards. Chartists have a rule of thumb to confirm that. They draw in a trend line along the low points. If there are 3 points of contact, each one higher than the last, then an upwards trend has been established. Conversely, when the general trend of a share seems to be downward, draw in a trend line above the pattern this time, and again look for 3 points of contact. Here, there are 3 points where sellers have clearly pushed the price down. There are always enough sellers to resist a substantial rise. So now you're well on the way to charting a share and predicting its future movement. The interaction of buyers' support and sellers' resistance lies at the root of everything we're going to discuss. If it all sounds a bit theoretical, let's look at a real example. Sainsbury's has been one of the most popular retail shares of the 80s. Here's how it performed in 85-86. Draw in your trend line, and there are 3 points of contact on an upwards trend. If you're a long-term investor, you'd stay with that trend. If you're a more active investor, you might wish to get your money out when the share starts to fall and back in again when it's rising again. Indeed, wouldn't we all like to do that? Chartists have a number of recognizable methods which can help. They're not the philosopher's stone, but they are useful indicators. You can improve the timing of your investment decisions dramatically. First, continuation patterns. These are formations which tell us whether a share will persist in its current direction, up or down. The first continuation pattern we'll look at is called the triangle. At the outset of 1985, a little-known company called Pentland Industries was worth around 20 pence. Suddenly, in the space of a few months, the share trebled in value. Something was up, but what? Well, as private investors, we'd be the last to know, wouldn't we? In fact, word had got out in the city that Pentland had made a brilliant investment in the US. They'd bought a large stake in the company making these, the Reebok training shoe. Its prospect in that nation of joggers seemed bright indeed. However, when it had sprinted to around 60 pence, it then fell back to 40 pence in just a couple of weeks. What had happened? Was it just profit-taking by investors who'd been in at the beginning, or was there a real problem? Well, over the next 6 months, the share rose and fell. The picture didn't seem very clear. Was it a good time to buy or not? That's where the triangle comes in. When faced with this particular pattern of investor behavior, chartists draw in a triangle. It reflects an argument between buyers and sellers. Towards its tip, on the right, the opinions of buyers and sellers are more intense. The outcome is likely to be explosive when the share breaks out again. The chartists measure the height of the triangle on the left and wait. Then, when the share price breaks out of the triangle, upwards in this case, they predict a minimum rise of the same amount. And that's exactly what happened, and better. Does it still seem like witchcraft?
It's true that a lot of people still think of it as black magic, quite correct. But it's quite surprising how people who are totally unpredictable in their everyday life can suddenly become extremely predictable in stock market terms. They manage to panic together, and they manage to gain their enthusiasm together. They act, as you've already said, as a herd instinct.
To me, as a layman, viewed against the complex background of the markets, this triangle pattern somehow seems too neat for words.
Yes, it does look totally mathematical, but we've been studying charts here since 1945, well over 40 years now, and these patterns just go on and on repeating themselves in both bull and bear markets.
In 1973, the share price of Marks & Spencer was falling. It wasn't particularly surprising because, as you may remember, quite a vicious bear market was developing at the time. Then, in the winter of 73-74, the share hit a period of relative equilibrium, where buyers prevented it falling much lower, but sellers prevented any substantial rise either. When faced with this pattern of investor behavior, chartists draw in what they call a rectangle. Then they wait to see when the share price will penetrate the rectangle. In this case, it penetrated downwards, not surprisingly in a bear market. The height of the rectangle is then used to predict a minimum expected fall below the rectangle. In this case, the predicted fall happened, and worse.
There's no reason at all why a private investor couldn't begin to interpret a chart just as quickly as any professional investor. And when it comes to something like the rectangle, it's an important pattern, and it will almost certainly dominate that part of the chart. And if it doesn't leap out at him, whether he's private or professional, then he should ignore it, because one of the basic dangers is looking for patterns. But when this leaps out, he will be able to see the upper parameters and the lower parameters as well as any professional.
Let's return for a moment to the story of Pentland Industries and the Reebok running shoe. When we last saw the share at the beginning of 1986, it had broken out of its triangle and was easing ahead. In its almost vertical progress that summer, there were three small consolidations. brief periods of a few days or weeks when the share hesitated. Chartists call these flags, and they usually appear during a rapid rise or fall. In fact, following 3 flags, Pentland had topped £1.50 by June 1986. Chartists measure the steep movement in price before a flag and project a move of the same percentage once that pattern has been completed. Pentland was a perfect example because it rose by the predicted amount after the flag.
Normally we would give the flag 3 weeks. If it lasts for more than 3 weeks, then we would be looking for an entirely different pattern, probably one of the triangles which we've been discussing earlier. In the case of Pentland, of course, we had triangles and flags all the way up in that bull market. It really was a Chartist dream. We made a lot of money for our clients.
If you now want to rewind the tape and review trend lines, plus the 3 basic continuation patterns, the triangle, the rectangle, and the flag, please do so. But if you're comfortable with them, we'll move on to an even more important area. Up to now, we've looked at how you discover when prices will break out of a period of equilibrium and continue in the same direction. Now, and just as crucially, we'll consider how you spot when a primary trend is ending. When a bull market is coming to an end, the news in the papers remains good for a while. Here's a copy of the Financial Times for the day before the Wall Street crash of 1987. And it's full of good news. And even when a bear market is bottoming out, the papers are still full of disasters. It's easy in retrospect to see where the market sentiment changed, but how could you have known at the time? This is a key aspect of timing. Chartists use reversal patterns to guide them. And the first reversal pattern is known as a double top, but actually it's nothing to do with darts. In the bull market between 1969 and 1972, Lloyd's bank shares galloped ahead. New reporting methods adopted by banks were revealing substantial profits. By the spring of 1972, they'd topped £4. How much higher would they go? Well, they then dropped a bit, then returned to £4, and then dropped again. A horizontal line drawn in at the support point is known as a neckline. I promised you I'd tell you about it. At the second peak, investors who are surprised by the recent fall sell out and cause a second fall. If enough of them do so, the neckline is breached and further falls are then expected. At a minimum, the fall will equal the distance between the neckline and the peak, and that's exactly what happened in this case.
When you identify a double top, it's reflecting a change in sentiment from bull market to bear market, and it's very important that you don't get caught when the market begins to fall. In fact, this Lloyd's Bank case was right at the beginning of the 1972-4 bear market, which did a lot of damage to investors. By the end of that bear market, a stockbroker whom I know had filled his barn with corned beef and coal and had bought a shotgun to keep away the natives. It's very easy now to forget just how far sentiment and confidence can fall by the time bear markets finish.
In the early 80s, the dollar was what you might call the world's favourite currency. Its value, for instance, against the German mark rose consistently between 1980 and 1984 by over 90% in all. Like all the movements we've looked at, there were temporary ups and downs, but the overall trend was obvious. By February 1985, the dollar was worth almost 3 marks 50. But from there it fell and then hovered. What would happen next? Well, this pattern is well known to Chartists, a high peak in the middle flanked by 2 lower peaks, much like a head and shoulders, and that's what it's called. The principle is very similar to the double top. You draw in a neckline along the 2 troughs in the pattern, where support came in for the shares. When the line was broken, then Chartists who'd spotted what was going on predicted further falls. The minimum expectation was a fall equal to the distance between the peak and the neckline. In fact, by 1986, the dollar was down to below 2 marks 50.
When we predicted a fall of that size, the reaction was one of general disbelief. You've got to remember that the major idea was that the dollar was likely to be strong right throughout the whole decade. So the idea that it was going to go into a sharp fall was quite unexpected. We've got a number of clear trigger points which we monitor. When those are exceeded, and we'd like to see them exceeded by about 3%, then we can be fairly certain that there has been a major change of trend.
Now, as we've seen, a head and shoulders pattern reveals when a bull market is ending. But can it also help you recognize the end of a bear market?
Yes, we have what we call a reversed head and shoulders, which really is the same sort of pattern, but upside down. And the same predictions can be made and the same trigger points can be determined in advance.
Well, if a head and shoulders sounds like a shampoo, double bottom must be pages 3 and 4 of the Sun. But don't be put off by the chartist's jargon. They're only following a number of simple rules. The double bottom is actually the mirror image of the double top. It helps you predict when a share or currency is bottoming out and how far it might rise, a chance to invest when prices are low. So there are the basic reversal patterns: the double top, the head and shoulders, and the double bottom. Once again, if you'd like another look at them, rewind the tape and do so. I'll still be here when you get back. Now, as I said before, technical analysis is not the philosopher's stone. It's certainly not infallible. But from the days early this century when Charles Dow, of Dow Jones fame, first started to chart the movements of shares, charting has come a long way. Dow devised his averages simply to establish trends and trend changes. Now we can detect patterns of behavior and make predictions. And along with the primary patterns we've looked at, a range of extra indicators have been developed by chartists to help filter out mistakes. They're used for confirmation, really. We can look at some of them now.